Hello, and welcome back, guys. So, PayPal reported earnings, and the stock is down about 5.3% right now as I'm making this video. So, we're sitting at about $71 or close to that for the day that's gonna be opening up tomorrow. Now, we will examine what happened with the earnings report and also the financials of the company, a company which has been going down quite a lot in terms of its stock price. And so it may be a fantastic opportunity to potentially buy as it keeps going down. But let's first take a look at what happened during the earnings report, because the company looks like they beat on revenue, EPS, and guidance, yet the stock is still down. So, the company reported the first quarter revenue of 7 billion, 7.04, which is up 9% year over year. That's compared to the previous quarter, that's not the annual. And also the company reported earnings per share of $1.17 for the first quarter, beating the estimate of the street estimate of about $1.1 per share. Now, interesting to see that the total payment volume for the first quarter was up about 10% year over year, which is fantastic, obviously, because a payment company requires more payments, and so as customers make more payments, this is great news for the company and the stock, of course. And the transactions were also up about 13% year over year, with the overall active accounts for PayPal being up 1% year over year. So a little bit of a lesser growth in terms of the active accounts here, maybe some more competition potentially, but still an increase year over year, a little increase though. Now, the CEO said here that the company delivered stronger than expected performance, and that's true. That's what you are seeing here. And the company is also guiding for a second quarter revenue of about 6.5 to 7% year over year in terms of an increase, that is. Which is nice, again, a pretty solid increase year over year. Remember, the company didn't do well last year in terms of their net income. It was down about 50%, I believe. We're going to examine that in a little bit more detail because this potentially gives us a nice entry point as the net income is going down and the stock price is going down. It potentially gives off an interesting case, is the thing. Now, second quarter earnings per share are expected to be at about 1.15 to 1.17 compared to 1.04, so another potential bit here is what the company is expecting. And for the full fiscal year, PayPal is guiding for 4.95, higher than 4.36, significantly higher, that is. However, the price action is down, and even though everything looks pretty solid here, and also the company is buying back shares of about $4 billion, another nice thing to see here, still the stock is down. Now, $4 billion is not that much compared to the market cap, but it's something. It's like 3% of something or something of that sort. So it's not negligible for sure. But overall, we are looking at pretty solid numbers. And the stock is going down, and that can obviously happen because the stock market reaction can be completely opposite to what you're expecting. Now, for instance, the street may have been expecting higher growth from the company, from a company coming off of a pretty bad year, for instance, and you can kind of see it here in the financial statements of the company. Fiscal year 2022 was pretty horrible in terms of the net income here. You can see it about 42% down over here. So pretty significant. So maybe they expected even higher, even higher net income here potentially, and this could signal why the reaction. But what we do care about as investors is not how the street reacted, is how we should react compared to what the stock price is doing and compared to what the business is doing. And you will see that the P ratio of the company is sitting at 36, which potentially is going to go down a little bit more tomorrow, maybe sitting near 30 something, 32, 33, something of that sort. And the price to free cash flow is a little bit lower after the adjustments, so I'll tell you why a little bit later in the video. With outstanding shares going down, and they are going to be going down about 3% more, as we already talked about. The company has a little bit of extra liabilities than what we'd like to see and a little bit of debt. But again, they are very easy to fund. The company is making pretty solid free cash flow. And so I'm not really too worried about this one, especially with the company having a sort of like an outlier year where things didn't go that well. I think they should be fine in that front. Their net income margin is also down because obviously the company was negative for some quarters, for instance, and so this really dropped their margins here. But overall, they are sitting at about, as you'll see, 16%, 20%, near 20%, 14%. So this is the regular net income margin, that is. So the financial statements, they're very solid here. You will see in the 10-year period, 6.7 billion to 27 is a fantastic line of growth here from 2013, pretty solid growth. pretty nice numbers here every year. About 15 to 20% is what they have been doing, with only the last year not being great. And as you'll see here, their net income was bad for that year over here, the last fiscal year. Probably just a one-off case here for PayPal. Now, the balance sheets of the companies, likewise, you will see that we're looking at total equity that keeps increasing from 15 billion to 20 billion, another pretty solid round of increases here for the company overall. And the cash flow, affected obviously in the last fiscal year because of the lesser net income, yet still we're looking at about $5.1 billion of free cash flow, very similar to what they have been doing 5 years ago. But remember, they had pretty horrible net income in this past year. And as you'll see, after the stock-based compensation and depreciation amortization, this gets added back, and this gives us a little bit extra in terms of operating cash flow, because these are non-cash expenses is the thing, so they are added back to the free cash flow, to the cash flow, statement. And so you are looking at about 5.1 billion of free cash flow here. The thing is the company a buy in terms of the stock price is what we need to know, because what we're seeing right now in terms of the financials of the company is looking solid. But what about the actual price of the company, the actual price of the company stock? This is where a stock evaluator is going to help us with. And of course, every patron has access to this too, and our stock evaluator, of course, and every other stock as well. And you can find a link in the description box below this video if you're interested in becoming one, support the channel, and pretty much gain full access to the tool. And in this video, I'm going to be using numbers that are closer to something like 12 to 14%, which is mid-conservative, mid-slightly more aggressive, but I think the company will be achieving that pretty easily in the upcoming years. So I will go, let's just go 10, 12, and 14. I don't want to go too low because I think the company will quite easily be doing like 10% regularly for the next 5 years. And the net income margins that I'm going to be using, again, I'm not going to be using the outlier here. I don't think this is going to be the norm here. And obviously the averages have been dropping down because of the outlier. I think I'm going to go something like 14, 15, and 16 here. Just be a little bit more aggressive with my estimates here, which I think they're still very solid and fair. And in terms of free cash flow margins, the company is doing regularly a little bit more than 100%. I'm going to go 100, 105, and 110. And the annual return about 13%. They do more in free cash flow because they have a lot of adjustments for stock-based compensation and depreciation, amortization. And it's always something that you need to be mindful of when you're examining companies. And if I hit calculate here, you will see that with these kinds of estimates, we are sitting at a very nice target price. Now, low is 67, medium to 82, high at 100, and the current price is actually 71. Remember, it's down right now about 5%. So where we are at right now, this is looking like a buy, and I do like the company at that price. Now, obviously, I would love to get it at an even cheaper price, but the thing is, when you are buying a company that is fairly solid, they are growing, and they're growing at a very nice pace as well. They're making money, they're making good money compared to the stock price, and also they're coming off of a significant drop, so there's like the psychology of potentially bringing it up higher. So taking it for a swing could be a potentially interesting opportunity. I do kind of like it even for a long-term play here, and even if you decide to go a little bit more conservative here, and let's just say that you want to have net income margin that starts from like 10%, whoops, not 19. Let's say that you are willing to say that it's going to do 10%, 12 or 14 here, and you hit calculate, you're going to be a little bit lower, obviously, and like 66 for the medium, but still sitting at 71, 66, it's very close, and I do like it. So overall, I do like what the company is doing, and I have talked about the company's practices in the past. I don't like what the company has been doing in terms of its policies. They have been coming back with these terms of service nonsense, about misinformation and things of that sort that they had to take back and all that. I have made videos about all that. But the thing is, even if I don't like the policies of a company, I try to be as objective as possible. And if I'm seeing a company that is doing very well and their stock price is dropping and gives us a fairly solid entry opportunity, I'm going to tell you about it. And I think this one is one such case which I do like for a potentially sort of like long-term opportunity. You have to bear in mind that there is quite the competition here, with more players entering the market, becoming bigger as years progress. So there is competition, but PayPal is a household name as well, and lots of businesses are using it. It's sort of like the default in most situations here. Maybe Payoneer being like a second best, like for online ones, in many situations, but PayPal is sort of like the norm. So this definitely accounts for a lot, and it's important. So I do like PayPal. I do like that we're getting an even better price potentially here, and I could see myself potentially entering this one. Thank you for watching, guys, and I'll see you in the next video. Do tell me what you think about PayPal, by the way. Leave a comment below, and I'll see you in the next one, which is going to be about Palantir, by the way, so stay tuned. Bye-bye.